Good morning from our global headquarters in New York. I'm Menace Kearney. You're welcome to Bloomberg Brief. Let's set that agenda for you. Non-stop Fed speak. Goolsbee and Kashkari lay the groundwork for rate cuts in 2024. The euro drops as the data shows activity slowed last month amid French election risk. US PMI numbers hit the tape later this morning. And it is triple witching. $5.5 trillion worth of options set to expire, testing the market calm. There are many things that have been thrown at this market to try and test it, not least the triple witching that you have today, which is $5.5 trillion worth of options on indexes, stocks and ETFs. NVIDIA, here's a shocking fact for you. NVIDIA is the second big position after the S&P 500. But the flow show from Bank of America says very, very clearly, nearly $9 billion went into technology ETFs last week. You're looking at global equities, the biggest inflow since March of this year. So the momentum is there. When it comes to the calls from the market, Stifel joined Evercore saying 6,000 could be on the ticket before the end of the year. But once you've hit that 6,000 level, get ready for a 20% drop, steadying somewhere around a 13% drop for the year. Here we are with 10-year yields. Again, what you've got is the roadmap to cuts. It's that sort of languid dovishness coming from Barkin and Goolsbee. And yet the data also emboldens that call. Continuing claims the highest since March 2021. Home starts drop. We'll catch up with Mike McKee about the housing market in just a moment. The euro drops. That bounce back in activity hitting a small wall. You got the PMIs in Germany and in France, both weakening. We'll catch up on a roundup on that. Of course, I love the one phrase from the Dollar Weekly Greed Index. It's at a 4-month high. So there's a bit of exhaustion. That's what we're going to debate over the next hours. The scale of exhaustion is some of these moves. Now, the Fed, it still sticks to the fight. The fight is to get 2% inflation goal. The Chicago Fed President Austin Goolsbee spoke yesterday, and he feels optimistic about the recent economic data.
If we get more inflation readings like the one we just got, which were very strong, very encouraging, looking much more like the second half of last year, around 2%, then my view has been we can cut.
It's like the yellow brick road to cutting. Liz McCormick joins me now. She's on tour. She's in Singapore. Liz, good to see you this morning, this afternoon. The data has pivoted, according to Barkin, and Goolsbee says good inflation reports we can cut. This is the yellow brick road to reaffirmation of cuts, is it?
Yeah, I think, you know, they're of course, wanted to be cautious at the last Fed meeting. Chairman Powell was very cautious about things. At the day the CPI came out softer. But like you said, there's been more data since that's come out. We have these more Fed speakers like Goolsbee. You just showed that clip. I think they do see the window for cutting. I mean, their recent dot plot went down to 1, but I think if the data continues to lay out, you know, it's not unlikely that they do. The market is priced for just about 2, that's feasible. You know, I think they also, you know, they really don't want to impair the economy too much, so they're trying a balancing act. So if the data keeps coming, like you said, the data yesterday out of the U.S. was softer, so that was good for them. I think they are laying the groundwork that they see a window for cutting, but I don't think the total caution will go away. Like they want to say, we're being careful. But yeah, I think that, and the market sees it. They're not going over their skis like they used to, but they're about a little bit more easing aggressive than the Fed at the moment.
Yeah, the vigilantes seem to be easier to get over their skis rather than the bulls. And this takes us to your story, beautifully written piece this week. You talk about that pivot in the bond market where we've gone from quite considerable losses, more than 3%, to almost flat on the close of business as we go to the end of this week. What would you make of I want to understand what you make of the speed of that turnaround and how that correlates to the disinflation, because we come off that pretty awful hill or mound that they talked about in inflation in the first quarter. So just talk me through the speed of the turnaround in the bond market, Liz.
Yeah, it's pretty amazing. I will say volatility has been the order of the day in the bond market for a while now. But yeah, I mean, yields were up a little, so we're down a teeny bit more than when we wrote that story, but yields are down now in the early trading. So yeah, we're about flat after being down like nearly 3.5% in the U.S. Treasuries index in around April. But I think, yeah, you know, remember we came into this year, we had several hot inflation numbers. It seemed like complete turnaround, you know, maybe because they're going to be no Fed cuts, people were talking. So yields really came back up. And then we got some reprieve with that inflation data and some other data since. So the market, and again, they heard only one dot from the Fed, but they know the data is most important. So I think, now it looks like, and remember, you have a good coupon. So even when prices were going down, the fixed payment streams were a help. So I think that's what people think now. It's time to get back into bonds. I won't say who, talking to a fund manager here in Singapore, and they were saying they are heavily overweight treasuries, that they think, that's the place to be, that they think the Fed will end up probably cutting twice this year. So I think you have a lot of investors in that camp that, especially any backup in yields, they're kind of jumping in to buy again.
Okay, and just give us a little perspective. You're in Singapore. Tell me what the outside world is saying about whether they want to be lumping up and looking long in treasuries on political risk. Briefly, are they talking about election risk and using bonds as the hedge?
Yeah, well, that's all we keep asking, maybe because I'm a U.S. person, but the election risk, I keep hearing everyone say that, what they feel like is obviously going to be a lot of volatility. They feel like whoever, the worst case for bond folks is like a clean sweep, especially Republicans, because they feel like there'll be a lot more fiscal spending. Yep. They feel under any scenario, whichever party wins, we'll see more fiscal spending. So I just asked this investor who really liked treasuries, because of that political risk and the fiscal, what are they doing? So they said they're avoiding the long end. You hear that a lot. People don't like long maturity bonds, over 10 years especially, because, that's where eventually you might see some term premium come in, even if the Fed is cutting and rates come down, that maybe we'll see some re-steepening of that curve. But yeah, man, that's what's on top of everyone's mind is the political risk. And we've seen a lot of elections, around the globe, so we know things can go different than people think. But I think, and we have the debate next week, right? Yep. So we'll see some color on how these candidates look. So they're very top of mind, focused on the U.S. election.
Clear message from the global investor there, which is avoid the long end on the sweep. Liz, thank you very much. Safe travels. Enjoy the city. It is a pretty phenomenal destination in Singapore. So the U.S. futures market points to small moves after the AI-driven rally starting to lose steam. Traders gear up for what we're calling the triple witching. Marija Veitmane is senior multi-asset strategist at State Street. Marija, good to see you this morning. Again, I've got more letters in my inbox talking about 6,000 by the end of the year from Steve Fell. That joins Evercore, 6,000 by the end of the year. You've got rate cuts from the SMB. You've got the PBOC looking easier. Is the roadmap to rate cuts rolling up for you? Good morning.
Good morning. Rate cuts. I think the data from inflation is that, inflation is coming down. So we're going to get rate cuts. The question is when and how many. But, rate cuts are coming down. So that's supportive for equities in general. I think I would probably, going to jump on my favorite horse again and say that, tech looks great and that will support market. Rest of the market is looking a lot less strong. And rate cuts delays are increasingly painful for real economy. And we're seeing that in profits. We're seeing it at margins outside tech. But tech being so big, so strong, will probably continue to rally.
And in terms of the narrative that we're getting today, we've got this triple witching, and it makes a great headline. It's about indices, it's about ETFs, and it is about individual stocks. So to what extent do you make of this sort of benign volatility environment, the momentum that we've had? I want to understand from you. I look at these markets and I see a momentum, just a swell of money coming into these markets. But if you strip out NVIDIA, which is the second biggest element of this triple witching, it perhaps looks a little bit different.
Yeah, I think one of my favorite stats is that when we look at institutional investors' database from our custodial holdings, we see that investors are buying stocks. Allocation to equities are highest since GFC. So people are very, very long stocks. Which stocks are long? They're very long US stocks. Which stocks are very long in US? It's tech. And tech position is enormous. It's the largest since dot-com bubble. investors continue to increase. Investors continue to put money into it. So to your point on momentum, it is still very strong. And maybe to put the tech position in context, the second largest position is financials, and it's more than 5 times smaller. So yes, so there is huge enthusiasm about tech, but not very much else.
I mean, you have concern about the earnings growth outside large cap, don't you?
Absolutely, and particularly small caps. So that's really, I mean, I have to say small caps is probably the question I get asked most often about. When do you buy small caps? And I think our answer is that right now investors need to worry about earnings, and that's exactly what they're doing. They're buying quality, they're buying tech, large cap, and small caps are really where we're seeing kind of a problematic earnings story. Financing costs are rising, margins are slowing down. It's much harder to push higher prices to consumers. So that's really the area where we're seeing the biggest stress from potential kind of higher interest rates and tighter monetary conditions. So that's the area of stress, and that's where we're seeing the biggest underperformance, that we're seeing investors really hesitant about. So still kind of a big no to small caps.
If Danny was here, she'd be very upset. She'd be incredibly upset with you. Of course, she's on in the next couple of hours. We're looking at the PMI data from Europe. We're counting down to the PMI data here in the United States of America. You know, French, I'm looking here. You've got June manufacturing falling to 45.6. Services falls to 52.6 from 53.4. It's incremental, but it does sound as if Europe is hitting a headwind. I then look at the flow. Outflows for 5 straight weeks of $1 billion. You would contextualize the outflow, and you would put perhaps a differentiator in there, that French pain is Italian gain.
Yeah, that's the note we wrote on kind of post-French election. So and I think it's a really important point, Manos, that you bring up, that institutional investors have been selling French stocks ahead of the election. So the kind of the big sell-off we're seeing right now, institutional investors have been a bit ahead of it. So they've been reducing position in French stocks for a couple of months now. And to me, that's really a reflection of what are the biggest kind of sectors in French indices. It's industrials, it's consumer discretionary. That's the type of sectors that really struggling with this kind of weaker economy and kind of manufacturing slowdown. So that's what investors are unwinding. But it's really interesting. We are not seeing acceleration of the selling at all. It's just kind of, okay, we're reducing those positions. But interestingly, we see buying of Italian stocks. And again, it started very much before the elections we saw, like the European elections we saw, and kind of swing to right-wing parties. But so investors were buying. Again, what is the biggest components of Italian stock markets is financial. So, I mean, the Italian banks have taken a very long time to clean their balance sheets and strengthen them and return to profitability post-financial crisis. Now they're in a very good shape. They're reaping the benefits of it. So yeah, switch to kind of not try to catch the falling knife and kind of potentially oversold French stocks, but maybe go to Italy. So that's an idea we're thinking about.
Okay, I'm sure Andrea Orcel will enjoy that nice shout out for Italian banks. Marija, thank you. Always great to get you with us to close off the week where records have been made across these equity markets in the United States. Marija Veitmane there of State Street. Our stories trending on your Bloomberg Terminal this Friday morning. This is what we've got. Canada proposed tariffs on Chinese EVs after the US and EU moves. The government still has to make a final decision on how to proceed. Well, it's likely to announce soon the start of a public consultation on tariffs that would hit Chinese exports of EVs into Canada. Citi faulted by US regulators over wind-down scenario plans. Citi's blueprint for a hypothetical wind-down has been found to be lacking by the majority of the Federal Depository Insurance Corporation Board. Now, this is a blow to Jane Fraser's bid to improve the bank's risk controls. UK retail sales jumped the most since January as confidence grows. The figures come after a key survey showed consumer confidence rose to the highest level in 3 years. Coming up this hour, we catch up with Nancy Tengler of Laffer Tengler Investments on why we should forget data dependency. Listen to the companies. Context matters on Bloomberg.
Shareholders, don't worry about that SoftBank share price stuff. Dream's a big dream. Why don't you support Masayoshi Son, who has a big dream? I was born to realize ASI. AGI stimulates AGI and drive evolution. Less than 10 years, ASI will come.
SoftBank founder Masayoshi Son there claiming that he was born to realize artificial superintelligence at the company's annual general meeting a little bit earlier this morning. Here for a little bit more context around the AGM and the evangelist moment by the man himself is Bloomberg's Min-Jung Lee from Tokyo. Min, good to have you with me this morning. I mean, this sounds like an evangelist moment. We've done many things, but all that's been a warm-up for my dream to realize ASI. These are ambitious plans.
Exactly. Although the concept is not new, this is the first time Masayoshi Son has really promoted this idea and declared it, like you say, his new passion. And he said all of his attention is now focused around materializing this ASI. Which he said will be 10,000 times smarter than humans. It will also have emotions. It can even end wars. And he said ARM, the chip unit, will play a central role in this for SoftBank, and that SoftBank will actively seek partner companies to make this super machine intelligence a reality in 10 years. So this will naturally involve new big investments, possibly including the Zanagi project that Bloomberg reported about this year. So exciting things to come going forward.
Look, these ambitions come with CapEx and OpEx, and that is a direct challenge to the dividend share buyback narrative. How does he balance that narrative to the shareholders?
It seems like a difficult thing to balance, but based on what Masayoshi Son said, all of this is probably easy. What he did, like whether it be share buybacks, a share split, dividend payout, or even on the matter of like possibly taking the company private, he did not provide a clear yes or no answer to any of these possibilities. But he did clearly say that all of these are of little importance to him, that these are minor details in running SoftBank, that for him everything is now going to be about pursuing this artificial super intelligence. I don't know how shareholders took that, but
indeed.
But yeah.
Min, thank you so much for being with us. Min-Jung Lee, Bloomberg Tokyo technology reporter on the evangelist moment at SoftBank. This is Bloomberg. Bloomberg Brief, I'm Menace Cranny in New York. Time for your front pages. This Friday, what have we got? What are the headlines around the world? To politics. First up, you got Trump outraises Biden again as billionaire donors unleash vast sums of money to shape the race for the White House. President Biden and the Democrats raised $85 million in May. That falls short of the former president's $141 million. And falling behind Trump's campaign for the second month in a row. Money matters when it comes to politics. Next up, you got the Associated Press on the United Airlines jet that turned back to Connecticut. This was after a piece of the engine lining fell off during takeoff. The FAA said the crew members on the Airbus A320 jetliner heard what they call an abnormal noise shortly before the Denver-bound flight's takeoff. Pilots flew safely back to Bradley Airport. And breaking just over an hour ago, we had the Bloomberg lead story. Eurozone activity slows. Is it to do with French election risk? The risk is that the factory slump endures. Let's get a little bit more on the story. Kriti Gupta joins me now from London HQ. So we just heard from Marija Veitmane is that institutions were selling French assets before the election was called. So I wonder, are we putting the cart before the horse in terms of this slowdown, attributing it to politics rather than reality?
Well, man, this is kind of a perfect storm in Europe, as I'm sure you're familiar with. When you're looking at the French data in particular, you already had real weakness coming in some of those core economies in France, in Germany. The strength was coming in the periphery, in Spain and Italy. A lot of that a result of the fiscal spend from those various governments. It is now literally the inverse of what you saw in the early 2010s, I want to say 2011, 2012, where the core is starting to be weaker. And at the core of that core weakness is the manufacturing story. And that's really what's been underlined in the data that you saw in terms of the French PMIs, but also the German PMIs, to the point that it weighed on not only euro weakness, but a massive bid for the Bund as well during the European session, really just widening that spread amid the geopolitical risk you were talking about.
So it's interesting, you know, we're going to debate whether the Fed is live in July, but I'm just looking at the odds for a ECB. We're looking at the traders now, 80% chance of a third ECB cut this year. So this slowdown, this headwind is going to embolden the rate cutting narrative again, isn't it?
It is, and you saw as the data dropped that immediately the swaps around the ECB pricing did kind of solidify a cut for October as well. That wasn't in the pricing beforehand. It is interesting that you bring in the Fed as well, because the kind of argument, especially here in the UK, but argument in Europe as well, is that the reaction function needs to be kind of front run to really tackle further weakness that they're expecting, not only in the back half of the year, but as a result and as a read through of potential Chinese weakness into the European economy as well. So a lot of hedging, a lot of commentary as well on what that means for a euro that's really keeping an eye on France, but is also very aware of what that tariff story and that trade story looks like going into next year.
Yeah, the euro's come off its lows, and also we had the PMIs. You didn't quite get there for the UK, slipping to 51.7 from 53. That's the lowest since November, as you're going to an election in the United Kingdom. We'll keep an eye down for the US numbers a little bit later today. Critty, thank you very much for joining me. Coming up, Nancy Tengler is in the house. This is Bloomberg. From our global headquarters in New York, very good morning. I'm Manus Cranny. Let's set your agenda. Non-stop Fed speak. Goolsbee and Kashkari lay the groundwork for a rate cut in 2024. The euro drops after data shows activity slowed last month amid French election risk. US PMI numbers hit the tape this morning. And it is triple witching. $5.5 trillion worth of options are set to expire. Will that test the market calm? A very good morning to you. The markets may be trying to grapple with triple witching, but for the moment, you have got a flow of money, a wall of money coming into these equity markets. Nearly $9 billion went into tech funds last week. You saw the biggest flow in globally into equities since March. So the flow show remains unabated. And it's a week where you've seen record after record. Nvidia is going to be the second biggest position in this triple witching. Stifel have a call out there. You're going to hit 6,000 and then bam, you're going to drop by 20%. I hope not. But you'll drop by 20% and you will recover. Don't worry. You'll only end the year down 13%. We're in fully fledged bubble mania mode. I really do hope we're not. To the bond market, 423 is where we are. Barkin and Goolsbee lay the yellow brick road to a rate cut. And the data is also giving them a helping hand. Continuing claims, home starts dropping. Are those fissures something that will morph into something more malevolent? Euro dollar drops as we see the PMIs lacking in velocity in Europe. So certainly the rebound hits a small roadblock. Is it something more substantial? That is the question for the ECB. Stocks in Europe saw outflows of $1 billion last week. That is 5 straight weeks of divesting. Marija Veitmane from State Street say the institutions were ahead of that on the flow. OK, let's talk about the week that was. You've seen record after record here in the United States of America. The S&P delivering more than 30 record highs this year so far. Nvidia trumped Microsoft for the title as the most valuable company in the world. And the Nasdaq broke 20,000 for the first time. Thursday saw the market snap that 7-day winning streak. Let's bring in my guest. It is Nancy Tengler, CEO, CIO at Laffer Tengler Investments. Good morning.
Good morning, Manus.
Good to see you. Exuberance around. So I was with a meme stock trader yesterday. I don't know really what meme stocks are, but he reminded me of a great phrase, HODL. It's something in the whole crypto world. Hold on for dear life. Is that kind of how it feels at the moment?
Well, I've been through this before a few times, actually, but particularly in the 1990s. I don't think we're there yet, but I do think we need to take a break because the market's just been pounding higher every day, and it's the same stocks. And we need to see broadening, of course, but we also just need for things to. I think when the hedgies go to the Hamptons, which maybe is this week, we'll get some pullback, and we'll see volume decline and prices moderate.
Can I just say to the producers of this show, I want that cut for social. When the hedgies go to the Hamptons, it's maybe time to take a break. What is the worst mistake that I could make at the moment as an investor?
Yeah, chasing these names. I mean, look, years ago, the comparisons being made from NVIDIA to Cisco. And we saw that stock was trading at a multiple of 100 times by the end of the 90s. And what's interesting to me is that John Chambers, who was the CEO then of Cisco, has come out and said, AI is bigger than the internet and cloud computing combined. So I don't know, I don't know where we are in this process, but I do think what we're hearing from the CEOs, the good CEOs, is that the use cases are expanding, and it's not just companies. And I loved the quote you gave in the break. It's also sovereign nations that are trying to develop their own AI. That was from Michael Dell.
And I think the sovereign story could be the floor in this situation if you get a slowdown. I want to put this to you. So we were having a look at a Bloomberg opinion column, and it's from LucidWorks, and it's a quote, and I just want to get your take on it, and this is what they say. The proportion of global companies planning to increase their spending on AI over the next 12 months. I was really shocked at this, right? So it goes from 93%, that's full metal jacket, full bull.
Right.
Throw the money out, just throw it there. That's down to 63%. If we slow down at all, then I wonder what this does to the picks and shovels story. Is this the kind of data that will give the market pause for breath?
Yeah, I think so. I think it's pivotal. I had not seen that story, so thank you.
No, it's a great opinion columnist. I'd encourage everybody to go and read it.
Yeah. I think you have to worry about that, but then you also have to think about, okay, well, where is the spend going? And so we've been shifting to names like CrowdStrike, and we already owned Palo Alto Networks, cybersecurity names that are essential, that will continue to be essential no matter how much spending goes into generative AI. So I do think there's places always to make money, but you just have to not be greedy and chase these names as they're running. Let them pull back, take a break, and then step in.
I would emphasize that you're still fundamentally you're an earnings bull, even when you strip out Mag 7. So just run me through the thesis on that, because it holds for you.
Yeah, well, and it's been a real. Last quarter was a great earnings season. The guidance went up in many of the names we own. We had a series of beat, and raises. That the margins are expanding. So I think as an investor, you want to look for those opportunities. If you're an investor and not a trader, if you're a trader, chase the utilities. I just don't think that's going to be a sustainable growth trade. And ultimately, stocks trade on earnings growth.
I ask you this each time we come in, and the market is at mini loggerheads, I'd say, with the Fed. Goolsbee and Barkin try to sort of, I think, give succor to the market about we will get there. Does rate cuts matter? Rate cuts do matter, and they matter for breadth, and they matter for the real economy, and they matter for no hard landing. But the thesis of how you look at markets, how much impact are 2 rate cuts to you?
Not meaningful. I think I've stopped listening to the Fed. I think data dependent has become the new transitory. Like you heard Christine Lagarde's press conference at the ECB. She must have said data dependent 20 times, and yet they raised their inflation guideline, right? So estimates. And their key metric was wages, and they said if wages come down, we're going to cut. Wages actually went up, and they cut anyway. So you've got a central bank land that is saying one thing, but acting the opposite. And we even heard some of that from Fed Chairman Powell at his press conference, where he said, 2.6 to 2.7%, that's not a bad place to be.
No, and it doesn't need to be at 2%. They keep saying to us, look, it doesn't need to be at 2% for us to get this cutting cycle underway.
Right, and that's why I've stopped listening, because in the 90s we had inflation above 3% on average for the whole decade. The 10-year was between 5 and 7% the entire decade, and yet it coexisted with robust stock prices.
If you if you look at some of the softer data, the Philly Fed hit a 5-month low yesterday. Building permits. We're going to catch up with Mike in just a moment. He's going to talk us through the housing market. You know, there's little pieces of slowdown here, sentiment and data. Now, when you look at that, are you tempted into slightly more? You can see the argument of, I'll pull back from deploying to equity and I will deploy more to bonds. That, you know, you're rebalancing at some level. Does that make any sense?
Yeah, it does, but you know, bonds have not actually been that great of an investment this year, nor last. And so we've kept our clients really short at the short end of the curve, and we've just rolled those maturities. We started to extend a little bit, but I think if you are in the mode of wanting to make money in a defensive way, maybe a better way to do that is with dividend growing stocks, because you're still getting the equity kicker up and down. But on average, over time, you know, stocks over the last 30 years have returned 10.3%. The next closest asset class is gold at 5%. So I'm not a big, this is the first time in my life I've owned a bond. And I know. And I'm up
What
there.
is it that took you over the hill? What is it that took you over the over the fence? Tell me.
It was the yields on the short end.
Okay.
You know, it's 5.5%. It was better than cash, so I just parked a little bit there. Money I knew I was going to need for a remodel, but I'm still fully invested in equities, and so are most of our clients.
You just got to find the right builder. Can tell you, it can be tough. Look, on the consumer side, the retail sales numbers, you can put them down as flat or a little bit disappointing, and we all sort of went, oh, there's cracks in the consumer, the hedonism of the U.S. consumer. Do you feel that at all? Do you see? I certainly don't see that, but then I'm living in New York. I'm living in an abstract.
Yeah.
But that consumer can turn quite quickly to a downturn, can't it? This is what we've seen before in episodes of downturn.
Yeah. Yeah, no, you're absolutely right. And I think only on Wall Street do we say inflation is coming down when it's just not going up as quickly. Because the average consumer is still paying. You know, I went to the vet and I paid $300 for my dog to get, you know, the regular vaccinations. The vet services are up 33%. In Arizona, where I spend half my time, home insurance is up almost 70% since 2020. And so I think what we have to realize is the low-end consumer is getting squeezed. Average hourly earnings are down. Personal savings is down.
Does that have a consequence for portfolio for you? Are you beginning to make moves on consumer side of the portfolio?
Yeah, we've reduced our exposure to consumer discretionary, which was a favorite, and we've pivoted to names like Walmart, which meets our investing theme of old economy companies that have pivoted to the new technology, and then they're in the sweet spot of the consumer.
I hope that dog knows how pampered a pooch it really is. Nancy, thank you very much for being with us. Some great lines, as usual, from Nancy Tengler of Laffer Tengler Investments on Bloomberg this morning from a very hot and beautiful New York City. Good morning. It's your Friday edition of Bloomberg Brief with me, Menace Cranny. Danny Berger will return on Monday. $5.5 trillion worth of options are set to expire. Today, it is triple witching. What does that mean with a background of risk as it stands at the moment, record after record in the equity market? Simon White is with me. So, Simon, this is about indexes, this is about stocks and ETFs. What is and how important is triple witching?
I think it's one of these things that if you are a market practitioner, it's obviously very important. But I think if you are a slightly longer term investor, then you may not notice it because the volatility can happen at the end of the day. It can then often be reversed, if the price move the week after. So again, it depends kind of, who you are. I think it's a shorter term thing often. I think it does affect the market further out, into the next quarter because, say, in this situation, what you have is a lot of what they call gamma rolling off the books. Now, gamma, all you really need to know about that is when there's lots of gamma, the people that, the other side of these options, they have to hedge that gamma, and that tends to repress the volatility of the market. So the market tends not to, have big sort of lurches, and it might do on an intraday basis, but, on a day-to-day basis, it doesn't tend to do that. So, potentially with this larger amount than normal, think of gamma coming off, maybe over the next few weeks, you could see a bit more volatility. But that doesn't necessarily mean which direction, which the price is going to go in. But there will be probably more volatility on the back of that. So that's really the main takeaway. I think there's other things that are more important for investors, and like liquidity, and it's going to have much more of an impact on longer term price.
It's interesting. I mean, just on that, there's such a mountain of calls relative to puts in this triple witching. I think that's in the story. Nancy Tengler was just with me there talking about, when the hedges go away, this liquidity may change in these markets. And the one thing that she warned about is chasing this market. Now, you talk about liquidity in your next column, in your latest column. And I love the phrase, the irrepressible wave of liquidity. Will this environment persist, or when the hedges go to the Hamptons, might it materially change? Or the south of France, if you're in Europe?
Exactly. Potentially. I think, look, there's that kind of liquidity, there's that market liquidity. Then there's what I call excess liquidity, which works over longer periods of time, like, 6 months and that sort of time period. There's also central bank liquidity as well. And I think that's quite important right now because when I say central bank liquidity, I mean the bank reserves of the Federal Reserve. And right now we are in tax repayment season. So basically the Treasury account at the Fed has started to rise. So basically people are paying back their taxes. That takes reserves out of the system. And until the Treasury decides to spend them, that actually takes liquidity out of the system. So over the very short-term period, you could see some pressure on prices from that.
Simon, let's see how the triple witching goes and plays out today. Simon White at London HQ, setting the stage for a little bit of a bumpy ride, maybe later today. Our exclusive interview with Howard Marks, Oaktree co-chairman, turns to the Chinese market, the opportunities. Let's take a listen.
Given that the U.S. is priced highly, a lot of the opportunities for bargains are outside the U.S. Obviously, China is on a lot of people's uninvestable list. That tends to depress its value, and we like to look at things that other people aren't interested in. So China is one good example. But we are not macro investors. We're not top down. We don't affect a geographic diversification for its own sake. We go where the bargains are, and we're finding lots of bargains in many places.
And Howard, you mentioned about China giving you good opportunities outside the U.S. In particular, I know you guys focus more on the loan side of things when it comes to your distress strategy in China. How are you viewing distressed properties now in the mainland? Is there a sense that you're adding to your exposure in any way or backing away from this sector now?
We've been investors in NPLs for close to 10 years, non-performing loans, that is. Every banking system generates some non-performing loans. China has set up mechanisms to get them off the bank's books. And we've been participating for, as I say, close to 10 years. The legal system has operated as it should. We're happy to continue in that role, and we're not backing away.
In terms of, obviously, you were kind of caught up in what happened with Evergrande as a creditor. I'm just wondering, were there any lessons that were learned from this fallout from Evergrande and this downfall? And how much of the assets was Oaktree able to salvage?
The lesson is to be careful when supply is created by strong availability of capital. Capital was made available to the property development sector so that it could contribute to GDP growth. It expanded rapidly. It made use of that capital. It built some buildings which from time to time turned out to have supply exceeding demand. We participated. I think another important lesson is it's a good idea to get collateral. We got collateral on our loans to Evergrande when many others didn't. And we think we're coming out very well. as I mentioned, the legal system is performing for us. We have gotten control of the collateral, and there haven't been any disappointments on that front. So, as I say, we're continuing with our involvement.
Lesson 101, make sure you get good collateral when you go into a deal. Oaktree Capital co-chairman Howard Marks speaking to the team, Yvonne Mann and Annabelle Drewlers, a little bit earlier today. Coming up in the show, it is about the economic data, of course, and the earnings to round out the week. Context matters on Bloomberg. Good morning from New York. It's Bloomberg Brief with me, Menace Crenny in New York. Here's a look at what is ahead of you today. You've got the auto retailer CarMax reporting their earnings before the bell. The S&P's U.S. manufacturing and services PMI numbers hit the tape at 9:45 a.m. Let's see, do they follow Europe in the same direction, which was disappointing. We get the May existing home sales at 10 a.m. Let's talk a little bit about the housing market. Mike McKee has joined me around the desk. Good morning, Mike. Good to see you. So the housing market in the U.S., if you look at some of the data that we've had, housing starts a little bit less than, dropped by more than 5%. Building permits also under pressure. But you would say, look, don't worry too much about the data. It's fundamentally a supply issue here.
It is a supply issue. The Biden administration talking about giving people some extra money to buy houses, that stokes demand. But if there's no houses to buy, that's a problem. And we saw that with the housing starts yesterday come in disappointing. Just not enough housing is being built at this point. And you can see here the way that housing vacancy rate, the blue line, is very, very low while demand is high. So people are looking to buy houses, but they don't want to trade in their mortgages on existing homes, and there aren't enough new homes being built. So at the moment, we're really stuck.
We're stuck, but yet you look at the mortgage rate. I mean, this has now dropped. It's small, it's incremental, but we're below 7% for the first time since March. Here's the cart and the horse. You need rate cuts to really significantly change the price of a 30-year mortgage. You've got an election. Nobody really wants to touch the long end of the curve. That's certainly according to Liz McCormick. So this market is also stuck by the mortgage availability and the mortgage rates.
Well, everybody's waiting on the Fed. That's what it kind of comes down to at this point. The question is, when the Fed starts cutting, do they do one or two? Because what's the mortgage level that people will actually come back into the market? Like you said, we've come down under 7, but we're still in the high
50 basis
6s.
Points is not going to really move the dial, is it?
So what's it going to take to get people back into the market? There's been some theories somewhere around 4 to 5%. But we have a whole generation of people who grew up with very low mortgages, and anywhere from 2 to 4%. So they're looking at 5% or 6% and thinking, gee, that's high.
Yeah.
So it's a psychological question as well. And nothing's really going to change until we see the Fed do something.
Well, do you really want to double one of your biggest outgoings? And, has your income doubled in the 4 years since you took your mortgage at around 1.5% to 2%? Just very briefly, we've had a chorus of Fed speak this week. Are we any further on?
No.
I was trying to get bullish with Goolsbee and Parkin. I mean, Parkin did say, look, the data has pivoted again. I mean, that was a step forward.
They're all saying when you look at the CPI that we got and what they've imputed for the PCE coming up next Friday, that we're seeing progress on inflation. Just not enough at this point. And so you look at everybody who's spoken this week. We've had 10 of them speak on policy. A couple others spoke but didn't talk about monetary policy. And they all say the same thing. Things have improved. Things are looking better. We're not ready to move yet. And so we keep waiting.
You've given them a solid fail in terms of giving you any direction or any clarity. Mike, thank you very much. That is Mike McKee. We'll see what that housing data is a little bit later on. Bloomberg surveillance is up next. Markets this morning give back ever so slightly. It is triple witching. $5.5 trillion worth will expire in indexes, stocks and ETFs. Could bounce the market.